Hello, everyone. Thank you for joining us again today. And for those who just joined us, in the front of your lanyard should be a QR code. You can scan that QR code at any point in time to look at the schedule, program itself, and the speakers, and so on and so forth. As well, just a bit of housekeeping. It was looking at the bathrooms just around the corner next to one of the meeting rooms just to my left. I want to call up all the discussants for today. James, thank you. Travers, Masaki, Alejandro, and online we should have two other discussants, Hiromi and Andrew. Beautiful, great. And as well, obviously, of course, our session chair, Stephanie. So please, yours.
Good morning, everyone. It's so lovely to see you all here discussing what I think are some really exciting topics in blockchain. So here we have quite a distinguished panel, and I'm very honored to be the one to introduce you to them. We have so our James Angel, who is an associate professor at Georgetown University. We have Masaki Beshiko, head of the FinTech Center Payments and Settlement at Bank of Japan. We have Paul Travers, who is the Director in Risk and Treasury at KPMG Risk and Treasury. We have Alejandro Gutierrez, who is the founder and CEO at DeFacto. We have Lulio Vargas Cohen from Circle. Oh, we don't have him. I beg your pardon. He's online. There we go. And we have Hiromi Yamaoka from Decurrent DCP. Welcome. So how about we start this off so with a bit of an introduction on what we're going to be speaking on today. So this roundtable, I encourage everyone to put your hands up and to have an open discussion here because we definitely want to hear from everyone as well as our distinguished guests. So this roundtable is on the harmonization of CBDCs, deposit tokens, stablecoins, crypto assets, and DeFi. So let's kick this off with a bit of a big question. What are the main challenges in achieving interoperability among CBDCs, deposit tokens, stablecoins, crypto assets, and DeFi platforms? And I might just throw this along to James Angel to begin.
One of the big problems is the incentives that people have with different network effects. That when you have network industries, the dominant players have an incentive to block those competitors, because if you let the competitors into your network, there go your network advantages. So in a lot of network industries, you need a strong regulatory push in order to get people to cooperate and bring about interoperability. So for example, in the United States, in the early days of our telephony industry, telephone companies would not connect with each other. And it basically is a matter of federal law in the United States that forces telephone companies to interconnect. So, depending on the nature of the business and the industry, it may take a strong regulatory push to get interoperability.
That's a great answer. How about Masaki? Do you have an opinion on this?
Yeah, I'm on the same line. And actually, I work in a central bank, and I focus on the interoperability of CBDCs. And in talking about the topic, why to clearly differentiate a wholesale CBDC and retail CBDC. And I think talking about wholesale CBDC, one of the challenges in establishing interoperability across CBDCs of different currencies will be the access policy. Of course, we have some approaches to ensure interoperability of CBDCs, and that would include, for example, bilateral interlinking between two jurisdictions or multilateral platforms, which are being tested by some other initiatives, like, for example, mBridge of the Hong Kong Monetary Authority and Bank of Thailand and UAE and PBOC, or we have some other initiatives. But one thing we will need to consider is the access policy of central banks. Typically, central banks have access policy to limit access to central bank money to financial institutions to ensure the stability of monetary policy and also financial stability. And in addition to that, we will need to consider governance issues and legal issues. So technically, it might be possible to establish interoperability across different CBDCs, but from institutional aspects, we have a number of challenges. And on domestic interoperability between CBDC, retail CBDC, and wholesale CBDC, with other private forms of money, like, for example, deposit tokens or stable coins, probably will have similar challenges in domestic context. In particular, to promote the benefits of the tokenized deposit, it is important to establish an arrangement which enables transfer of deposit tokens across different financial institutions, but it might require some cooperative actions among different financial institutions. So I think we'll need to have some quasi-public initiative or engagement by the public sector to encourage such formation of collaborative arrangement. Thank you.
Absolutely. It would be great to hear from a founder's perspective. So we might pass the mic just back one to Alejandro and hear what you see as major challenges in interoperability.
Yeah, look, this is very interesting because you can see this from so many different angles. And I think like from the CBDCs and stablecoins, like if we go into the DeFi perspective, I think there are some other components that are really important. Like, yeah, definitely everything has to be with regulatory frameworks is extremely interesting in the space. Like when we saw that in Europe, for example, when Mika was studying, Mika per se is not actually defining anything yet with DeFi. However, starting actually setting up some foundations of what is coming, right? And what that made actually was an explosion of a lot of DeFi projects that are suddenly starting using all these interoperability between products, right? And different blockchains, right? So for me, one of the things that I'm seeing quite frequently is that a lot of the projects in the space are following more a Web3 mentality, and they're building in silos, which is completely the opposite of what it should have. Data should be actually be able to be shared among different players, and that creates actually a risk in the whole ecosystem, right? So for me, that mentality and that change in perspective that needs to be has to be an open foundational setup for financial systems that's not there yet, and I think that's one of the key components that needs to be happening.
That's a really good point. And someone who has definitely needed to collaborate with a lot of different protocols and chains is our friend up on here in the video from Circle, Lulio. I'd love to hear your perspective.
Yeah, hi, good morning. And apologies, my colleague Lulio couldn't join. I'm Andy Gallucci from Circle, but I want to on one thing that I heard during the previous panel by Dr. Staples. He raised a very good point, which is in my mind that the technology is not going to be the barrier to interoperability. Obviously, the technology can do very impressive things, as you can see, by things like mBridge. You know, and I think Dr. Staples made another good point, which is that it's really the legal and regulatory harmonization that is a, you know, that is a key barrier and challenge in this process. And what I mean by that is when you look at things like reconciling cross-border bankruptcy standards or redemption timelines, you know, reserving standards, these are going to be some of the key things that really, I think, add process and a lot of difficult questions, to be honest, that you can already see in the payments landscape, for example, just in terms of cross-border payments. I think there's a reason why there's not kind of, you know, what you would call like the super apps, you know, for global payments in quite the same way that there are in national and regional settings.
Great answer, and apologies, Andy. I'll make sure not to refer to you as Lulio. So I've been saving a couple of questions for Paul. So Paul at KPMG, and if we're going along that line of risk and interoperability, let's talk a little bit about the frameworks that allow that to happen. So how can regulatory frameworks evolve to accommodate the diverse characteristics of these digital finance elements while ensuring consumer protection and market stability? Big question.
That is a big question, thanks. And maybe to give a little bit of context, so my work at KPMG, I support organizations managing risk, specifically managing risk in financial markets, but coming more from what I would call a corporate perspective. So I help infrastructure projects. I help retail businesses. I help small financial institutions think about how do they manage risk, how do they manage risk in the financial markets, and then where do they embrace risk and where do they look to try and mitigate risk. And so then we come back around. I am going to get there.
Yeah, no, it's great.
To an answer. When we talk about the regulatory environment, it's thinking about the impact that you're having. And when you're having that impact on that market, and if you are wanting to consume these products, what does that mean in terms of what the regulators want you to do or are happy for you to do, and what protection mechanisms do they put in place to manage that? So if I take the Australian market, for instance, one of the key protections that they've put in place, which ASIC manages, is the AFSL. Which again, the Treasury has talked about in their recent paper. And one of the underlying objectives behind the AFSL is actually pushing that responsibility back upon the people that are participating in the market and providing the products in the market. So a number of you, I'm sure, have seen AFSLs or AFSL holders, but the logic behind that AFSL holder is that you show that you are qualified and that you have controls in place to manage that interaction with, and if I can use the broad word, the citizenship, and that might be wholesale, it might be retail, citizens in terms of your interaction with them from either providing product or taking product off of them. And in a way that the government feels that that's appropriate from their role of protecting citizens. So I've gone a long way around to saying that when we think about a regulatory environment, we're thinking about a regulatory environment that comes back upon yourself to understand the risks that you're managing and what impact those risks have.
Well, it's kind of a little ironic that you mentioned this, because I think a lot of people know that the crypto space started in a very libertarian sense. And a lot of the protocol founders from that age and kind of moving forward, less so now, but they had a great sense of responsibility in self-regulation and really taking that very seriously. Whereas now, personally, I do see some people who say, it's okay, we're not going to run into regulatory pressure because we pass through a gray area, but we're not at the end of either gray area. And I think it's attitudes like these that sometimes create a bit of a more dangerous situation. So what would you say, what happens in those circumstances when we have founders or communities that decide, I'm not going to take the front step and self-regulate, I'm going to allow them to come to us? Do you think that that's going to result in an over-regulation or an aggressive step forward in regulation?
I think the short answer is yes. And I think the longer answer is that by markets or institutions embracing what they do and to make their market stable, to make their market have an ability to regularly trade, will mean that you don't have that same regulatory type of pressure coming. And I think the great example that we see with that is the over-the-counter global market, and that the over-the-counter global market is effectively nearly a self-regulated market up until when we hit the GFC. And the G20 got nervous about this market that was out there that didn't have the transparency. And now we're being very much, that market has been pushed to be on central exchanges, but not from a global point of view. But if we think back to where that market started and where it really pushed, it actually pushed from the point of view of let's make sure we're providing the market a stable base in which to trade. And that stable base was documentation that supported doing trading on an international basis and also doing trading on a consistent basis. And that was where that market, I think, embraced that self-regulation and said, we will set that up. And that's where I think we've seen their success. And so I think that's the opportunity, because if you don't do that and you don't set up that strong framework, then you will have the regulators come down and try and say, from what we're trying to do from a protection point of view, which is really what their objective is at the end of the day, they will try and push that upon people.
Yeah, great point. So kind of following along this idea of risk. So I might direct this question to Masaki. So what risk management strategies are essential when dealing with the harmonization of all of these models?
Yeah, talking of harmonization of different digital assets, I think a distinction between money and non-money would be useful. And I think the discussion on money and on non-money will be totally different. And because I'm a central banker, I'll focus on money. And I think the important concept for us is to ensure a singleness of money. That means regardless of the nature of the money would have same value and same power to discharge financial obligations. And the core function of money is to discharge financial obligations. And it is quite important to ensure the stability of the financial system and also for the forward economic activities. And for that purpose, money has characteristics such as fungibility or convertibility at par with central bank money. And CBDC would play a role as a nominal anchor of value for other forms of money, even in the world of digital finance. And on top of that, to ensure at par convertibility with central bank money, I think private monies would have some regulatory arrangements to ensure the at par convertibility. That would include, for example, regulatory arrangement including fractional reserve system for banks, or consumer protection, or segregation of customers' assets for stablecoins. And in Japan, recently, new regulation to regulate stablecoins is introduced. And as far as I understand, the Japanese regulation has a full protection mechanisms for the holder of stablecoin, and that would also ensure the stablecoins function as money because of that arrangement. I'll stop here.
Absolutely. And I think a lot of us can recognize how much Japan is doing in that field and just how amazing that is. The next question I might direct up to Andy. So what technological innovations are required to support this seamless integration of all of these technologies?
Well, I think anyone on this panel would have any range of very good answers, but you know, I think this actually draws on your previous question as well. But I think when you look at the advantages and the properties of blockchain, you know, it's hard not to you know, draw back to the risks that certain attributes might make. And you know, to kind of pick up on the theme of the last question, I would have highlighted the fact that, you know, when it comes to, you know, financial settlement, counterparty risk, a lot of these issues are very, you know, very well known, well trodden. It's really the operational risks and the operational components when it comes to, you know, token management, you know, that are in many ways, you know, completely new. And I think that the fact is that you see these, you know, the kind of the core characteristics of blockchain, you know, traceable, you know, near instant, you know, a lot of these things, you know, that manifest as you know, instant, you know, kind of proper access and other, you know, characteristics of, you know, of blockchain that you know, in my mind, solve some of the issues that the bank of our colleague from the Bank of Japan was just noting about creating essentially digital bearer assets. But, you know, safe to say that the technological aspects, I think, come with a lot of these risks that are really, you know, that are just, we're in the kind of the early stages of understanding and mapping out in the same way that the financial risks are.
Absolutely. And Hiromi, I'd love to hear a little bit about that from you.
Yeah. There's a bunch of issues. So I'd like to focus on the interoperability in the domestic sense. Yeah, there's always a discussion about the singleness of money, which is very important in thinking about the interoperability of the CBDC and tokenized asset, because we have had a bank regulation and deposit insurance system. in order to maintain the credibility of bank deposit, in order to maintain the seamless money. In every country, the bank deposit, commercial money and the central bank money, that would be a CBDC. It is interchangeable one by one, always. So in order to maintain this kind of singleness of money, we have a bank regulation and bank deposit. So in thinking about the interoperability of the central bank liability and the commercial bank liability, we have to consider how we should maintain the function of the bank regulation, the bank deposit, in order to maintain the, credibility of the overall payment network with the bank and the commercial, central bank, the commercial bank. And of course, in terms of the, technological aspect of the interoperability, as you know, the central bank reserves are always digitized, already digitized. So I'm not very sure whether the wholesale CBDC should use the blockchain or DLT or not. It is still an open question. And if we think about the interoperability in a technological sense, we have to think about the interoperability of the blockchain technology among the various network of the tokenized deposit or the stablecoins in the future. Thank you.
Thank you, Hiromi. And I'd love to, of course, yeah.
I'd like to add to that. Technology is knowing how to do things. And one of the big technological advances we need is in regulatory technology, in that we need regulators who understand what they're doing. We need legislators who can create the possibility for the regulators, because in some countries like my own, we have very fragmented regulation. And depending on which box you check, you may get a very different group of regulators. And that can create lots of opportunities for regulatory arbitrage, as well as delays in getting the right things done.
That's a very good point. And so just following on that thought, so what would the difference be in that circumstance? So say we have this fragmented governance at the moment, and then, in the world where it is actually, we do have the regulatory clarity and regulatory technology to support these technologies. What is different for the consumer and for the founder?
Well, I think we always need to remember that as we look at these technologies, we need to think about what do those tokens actually represent? What are the legal rights of the owners of these assets? Because what our technology creates is really new rails, new ways of storing and transferring and registering assets. But at the end of the line, the real question is, what do those assets represent? So we have to have a sound legal basis so that if we're going to be harmonizing these assets, there needs to be a harmony of what those assets represent.
Yeah, absolutely. That's a really good point. And I think more so as we're seeing a lot of protocols that are tokenizing real life aspects, such as, we saw the rise of sweat tokens and, tokens for walking or for working or these kind of things. It actually becomes something that's quite difficult to regulate, and it becomes past what we consider as money into something that is just tokenized life. So I'd really like to go along the line, including our friends up on our video, and just talk about why it is actually, like, what is the big thing that you're looking forward to in terms of, once we're passed through this cloud of, a nascent technology and that environment, when we come through to the other side, what is really going to be available to us as consumers that you're excited about? Perhaps we'll start.
So from our side, we are in the tokenization of real world asset space for liquidity purposes, and that's a big topic. Why? Because suddenly we're starting seeing real applications coming from the DeFi space that are tapping actually into traditional financial services. What I'm trying to say, this is for a lot of traditional financiers, tapping or using this technology is something that is not there. So creating those rails is one of the key components, right? Because I think one of the issues that we're having is we need to decouple technology from the applications. Technology is technology, and technology is agnostic, and how you use it is up to you, right? But application is where it's at, right? And we have passed, I think, the point of building stack and everything is about technology. Now we're just moving into solving real world problems, right? And for where we're seeing it, like you see tons of applications of this in Africa, in South America, and Latin America, because they have real needs actually. So for me, the excitement at the moment is like, look, putting these new technologies, these new applications actually for solving real world problems. For solving problems in developing countries, right? And for that, one of the key things that I see is helping people with working capital and liquidity. And I believe that this technology can do that actually in a big scale.
That's a really noble goal. I have seen previously there have been some projects that have been providing wallets to women in those countries that previously haven't been banked. And that's been a massive step forward in terms of domestic violence and situations like that. We might pass back and then forward if that's okay.
All right. Well, what we do in financial services is we help people live better lives. We create solutions to a lot of problems, whether it's transferring purchasing power through payments, whether it is unbundling the timing of when we earn money and when we spend money. We provide investment opportunities to save for retirement, provide borrowing opportunities to buy houses and cars. We provide risk management opportunities like insurance and other things. So we help bring together capital from all over the world to build the enterprises that make our modern lifestyle possible. And that's what our financial markets do to benefit society. And I see what we're doing here is helping us in this noble process of reducing friction so that our payment system is one where payments are near instant, near frictionless, one in which we have more global inclusion so that everyone has access to the benefits of financial services that we in the middle class in developed countries take for granted, but we still don't have, we still have over 1 billion people on this planet without the functional equivalent of a bank account. Notice I did not say bank account, I said functional equivalent. Because when you say bank account, you're basically assuming a very particular organizational structure. But when we think about the benefits of financial services, that's the end game. That's the dream here. But not only making existing services more frictionless, but also producing more services that we haven't even dreamed of inventing yet. And that's what this technology does. It lowers the cost. It creates additional ways of doing things. And so we want an innovative environment where that can happen. Sorry if I get long-winded here.
No, I love that, James. And what you really convey is the passion of what just has not been created yet. And I think that's something that often when we're talking about these things that are quite difficult to conceptualize in terms of regulatory clarity and even the technology, when you get deep into risk, I think that sometimes it's difficult to see the forest for the trees, and that passion, it does not go unnoticed. So we might pass back to Masaki.
Yeah, we've already discussed about the opportunities for consumers, but on top of that, I think we should look at the opportunities for corporates or enterprises. And I think I have 2 points to highlight. The first point is opportunities of smart contracts, which is enabled by tokenization. And at this moment, the corporate transactions have a number of pain points which requires complicated business processing. For example, the supply chain financing or trade financing or collateral management, as these transactions require paper chases with a number of processes of consolidation or other processing. And smart contracts could have opportunities to introduce dramatic efficiency in this processing. I think leveraging the blockchain or smart contracts to introduce such efficiency will be really the key for success. And another point I'm now interested in is the concept of unified ledger, where various kinds of digital assets are circulated and recorded. And I think it's conceptually very interesting. And from the perspective of network externality, it has a huge benefit. But on the other hand, we will need to consider carefully the challenges around that concept. And that could include, for example, risks of scalability issues or risks of concentration on a specific platform or single point of failure, or governance issues would be huge if we try to establish a single platform for that purpose. But anyway, we are interested in that kind of discussion, and we will continue to engage with the parties which are pushing for that kind of initiative. Thank you.
Amazing. How about you, Paul?
So in terms of what I think is having the opportunity, and somebody's already mentioned the corporate perspective, giving the corporates an opportunity to exchange value where they want to exchange value. And one of the challenges that corporates have is quite often when they're either providing a product or a service, or they're looking to buy products or services, where they have to provide that product or service and where they collect it is not the same location, not the same value. And if they can look at opportunities to equalize that, and when we talk about that equalization, that can be across commodities, it can be across currencies, and potentially now across other mediums like tokens. What the corporate is looking to do, and my perspective when I think of a corporate, I'm thinking from a risk point of view. I want to equalize that so that I'm making sure that the return that I'm generating for creating the service or creating the product matches what I'm having to pay to do that process. And therefore, if I can do that by taking out intermediaries and taking out other people that influence the value and get that direct relationship coming through, then that's a great objective. When I talk with, particularly with corporate treasurers, I say the challenge that you have is your marketing area is going to walk into you one day and say, I don't want our customers to be they don't want to give us currency, they want to give us tokens, or they want to give us digital currencies, or they want to give us something else because that matches what they're trying to do on the other side. And as a treasurer, you need to be ready to accept that and then managing the risks that come from that. And I see that also flows from a personal point of view, that we're going to be able to better match our needs with where we have value.
So essentially, with efficiency and flexibility, we'll have this great new paradigm.
That's the idea. And I think the other point, and you raised it in terms of talking about the smart contracts, we're already starting to see that in trade finance and working capital, where smart contracts are being used to facilitate and get rid of the archaic ways that we handle letters of credit and things like that, and that we handle it more through a blockchain type of smart contract. And I think that's a great example.
It's amazing. We might pass up to Hiromi.
Yeah, okay. One of the major objectives to use a stablecoin or blockchain-based payment instrument is that there's lots of new kind of digital assets, that is a tokenized asset. So why we tokenize the asset? One of the reasons is that in order to make a transaction with the asset which were not available before, or to make a transaction of the asset more smoothly or with less cost. That's a major objective. And there's lots of issues in terms of the tokenization of the asset, of course, and where and how the ownership of the tokenized asset moved in a legal sense. And what is the legal background of the smart contract? Is that some sort of the contract itself, or some sort of the condition to make the contract or not? And of course, the background of the collateralization using the tokenized asset. There's a lot of legal issues. So in the future, we need to think about how to harmonize the legal background or legal framework in making transaction to this asset. Thank you.
Absolutely. And just before we pass it forward to questions from the audience, I might pass this question up to Andy. Any kind of last statements on what you're very excited about?
Yeah, there were a lot of very good points raised, but I just had two additional notes. I think I'm most excited in the nearer term at a micro level for making the technology fade to the background. And what I mean by that is from a user standpoint, getting away from this idea of what blockchain you're operating on, how you pay your validation costs. I think that this is, kind of at the phase of the internet when it was very much, you have an America Online account and you can only send to other America Online users. I think we're getting towards, and I think in the next year, you'll see a lot of very important innovations in this space, kind of abstracting away the technology and making it easy, quite frankly, to engage without knowing that you're using blockchain. And then I think in the macro picture, I think a lot of the discussion that I've heard so far and that goes on in this space is very much zero sum in between CBDC or wholesale or retail or private stablecoin or private other asset. And I think that when you look at things like Enbridge and a lot of the very innovative things that are going on, I think it'll be a very big step when it eventually that conversation shifts to how all three of those kind of categories work together, because I think that is really how you realize Professor Angel's kind of vision of kind of a globally interoperable, usable payment system.
Yeah, absolutely. Great points. As a venture capitalist, I'm seeing now a rise in these protocols that are abstracting blockchain away from the user experience, and it's incredible. And it also abstracts away from even a financial sense as well, even if there are financial rails in the background. And I can tell you, it really does make an impact on consumer experience. So we have no time left, but does anyone have any burning questions from the audience? Mark.
Don, definitely getting a lot of airtime. This is good.
Central banks, when they say wholesale, sometimes they mean people who have an exchange settlement account. And when people say retail, they mean buying a coffee. But in the middle, there's all these much more complicated, large value, business to business programmable payments. So yeah, I'm just interested. What does wholesale mean? Does it mean supporting that, or does it mean just people already have an exchange settlement account?
Is anyone wanting to answer? Yes.
Yeah, I think the current structure of allocation of roles between the central bank money and private money would be for large value payment, which are typically carried out between banks, the world of central bank money. And on the other hand, retail transactions typically, which are carried out by consumers or some corporates, the world of cash. And the corporate transactions are somewhere between that. And in considering a potential CBDC, at least in my jurisdiction, one of the points we'll need to carefully consider is how we could avoid financial disintermediation. And of course, we have a couple of measures to mitigate the risk of excessive shift from private money to public money, but it is likely we will need to introduce some kind of caps for holdings and potentially caps for transactions. And if that is the case, I think central bank CBDC, either wholesale CBDC or retail CBDC, might be an instrument which is difficult for the corporates to access and use for the corporate transactions. And in this respect, I am interested in the potential of new forms of private monies. And I think private monies would continue to be a main player for the corporate transactions. And how we should introduce further efficiency in the world of private money is the agenda we will need to consider. And of course, the introduction of tokenized deposit, which leverage the DLT, would not necessarily require the introduction of wholesale CBDC for the settlement asset, for the transfer of such deposit tokens, but it might be useful to provide such instrument for the interbanks. And recently, some central banks are interested in this kind of idea. And just last week, the Monetary Authority of Singapore announced the live pilot of wholesale CBDC, which is used for the interbank settlement of tokenized deposit. Thank you.
Amazing. So we might cap it there, but I'd like to extend just some sincere congratulations on everything that you're doing in this field, and thanks for joining us at this conference. To Andy Gallucci from Circle up on our video here, James Angel from Georgetown University, Masaki Beshko from Bank of Japan, Paul Travers from KPMG Risk and Treasury, Alejandro Gutierrez from DeFacto, and also Hiromi Yamaoka from Decurrent. So thank you very, very much.
Also, everyone to Stephanie as well for such an amazing panel. Thank you. All right, we're going to break for around 15 minutes.